Double trouble. Nvidia and growth fears drag markets lower. Welcome to Market Insight. I'm David Pollard. A drop in tech stocks after a dramatic sell-off for US chipmaker Nvidia and expectations of fading global growth have fired a double barrel of risk-off sentiment at markets today. This as Wall Street returns to business in earnest after the Labor Day holiday, and as markets there and in Europe brace for key US jobs data ahead of central bank policy decisions later this month. So, uncertain times for investors, like our guest today, Ambrose Faulks, UK Fund Manager at Artemis. Welcome, Ambrose. Markets taking a very defensive posture today. Should investors be more risk tolerant, or are they overreacting to the news out there, or indeed perhaps underreacting?
Well, I think expectations have become a lot more elevated for things like Nvidia, as we went through the year. So it's even harder for them to keep beating sort of a rising bar. So, the Q2 revenue and EPS growth was about 120 and 150% respectively, which is objectively very robust. But when they then give third quarter guidance of 80% revenue growth, that is clearly a sort of sequential deceleration. So it does temper some of the frothy excitement, both around the stock and its peers. So there's a recalibration of its near-term prospects, rather than perhaps a reflection of its long-term structural concerns. I mean, the company continues to grow its share of the AI chip market. It's innovating, and its largest customers are some of the most profitable in the world, being sort of Google, Microsoft, Meta. So they've got a good solid backdrop. It's just a question of the valuation.
So to what extent will big tech names like Nvidia and others play a role in how markets go forward? Are we going to continue to see a major repricing of tech?
The interesting thing, I suppose, is Nvidia's sales are someone else's capex. So it's very hard to determine how long, those customers will continue to ramp that capex. I think the issue outside tech is that we've seen a slow but growing but somewhat patchy set of real genuine use cases of these companies. It's easier to see them within tech. Meta has benefited strongly from this. But what interests us as UK, managers, I suppose, is, there's a lot of market value tied up in these stocks. And at some stage, they've risen so much that there might need to be a rebalance, which should benefit other markets, even if it's just a rebalancing, or there could even be capital reallocated properly away into other geographies.
So the other part of the equation is the global growth story. That's obviously key to the outlook. How does Artemis see these fears over the US, China, and for that matter, Germany playing out in the coming months?
Well, the US has been an interesting one. The first half has seen growth slightly ahead of expectations. Data's been a bit better. So it's unsurprising that the earlier indications for H2 have actually been a bit weaker. We've clearly now had a couple of weaker ISM prints. You mentioned earlier, Friday's non-farm payrolls. All eyes will clearly be on that. It'll be critical, particularly after last month's clear miss. Was last month a weather-related event? What will the revisions be? I think the other thing with the US we have to bear in mind very closely is the political situation with two quite different choices on the ballot paper. When we move to China, their growth has been slowing for quite some time, particularly housing, but also manufacturing capacity, which has had an enormous sort of rollout, perhaps an overbuild, with a lot of that coming from actually the German Mittelstand sector. So all that capital equipment coming from Germany, which has been a huge tailwind for the German economy for really the last couple of decades. Now that's starting to fade. I think we'll have interesting ramifications for the German market, and the political situation in Germany does look a little bit more divisive potentially as well. We'll have to see how that pans out into the elections at the start of next year, having only just had the regional elections.
Increasingly, one outlier to those growth fears has been the UK. We've had strong factory data, not bad retail indicators, and services are on the up according to today's PMIs. What's your view on the UK at the moment?
I think the UK looks very exciting. Exciting in so much as the revisions have been much better than people expected. We had been looking and hoping for a GDP that would start with a 1 for this year, which may sound sort of small beer, but actually consensus estimates have been revised up. The interesting thing is that what's driven that so far this year has not been the UK consumer, where we actually still think that's the biggest sort of lever that's yet to come. The savings ratios are high, real wages are positive, inflation has come down, even though there will be a little bit of an uptick in inflation in the second half. As you alluded, services will probably be part of that. But we think actually when that savings ratio starts to come down, that consumption will be a real extra kicker for GDP growth. And actually, accordingly, based on what I've just said, you'd expect the Bank of England not to be under such rate cutting pressure. So sterling probably gets stronger against dollar and dollar pegged currencies as well.
So amid all those background factors, where does a UK fund manager like yourself, where do you put your money? Where do you see potential upside?
Well, I mean, the UK market is cheap. It's cheap in a global context, cheap versus its history, and our bond market and our politics is no longer a mess. So I think the engine room really is in the domestic earning stocks, which is really consumer discretionary and UK financials. We like the UK banks particularly. They have double-digit distribution yields, buying back a lot of shares at very cheap valuations. Our preferred pick here is Barclays, where they're 2 quarters into a 3-year restructuring program, and long may this continue.
Okay, Ambrose Faulks, UK Fund Manager at Artemis. Many thanks for sharing your thoughts with us today. That is Market Insight. You can watch more videos on Reuters.com.